Imagine this. You've spotted a stock you've been tracking and researching for months, and it finally dips to your price and you know this is your chance. However, you check your account balance and suddenly you realize you're short on cash. It is a temporary setback, but what if the opportunity is too good? Should you wait for another chance or find a way to make the most of it? Well, that's exactly where this feature comes in handy for you. MTF or Margin Trading Facility. What is MTF? Margin Trading Facility or MTF allows you to buy stocks by paying only a fraction of their total investment value, known as the margin, while your broker provides the remaining funds. However, MTF amplifies both risk and reward. On one hand, you can take positions in the market that you feel is a good opportunity by paying only a part of the total value. On the other hand, there are risks as well that are associated with MTF that are amplified due to leverage that one needs to be mindful of. Therefore, it is important to first understand how this feature works, and so in this video, we'll discuss everything you need to know about MTF. Here's how it works. Let's say you identify an opportunity and want to buy 100 shares of a company priced at ₹1,000 each, making a total investment of ₹1 lakh. Now, with the normal buy transaction, you will need the full ₹1 lakh upfront. If you don't have it right now, you miss the opportunity. However, with MTF, you can make the same ₹1 lakh investment immediately by paying only ₹25,000 as margin, while your broker funds the remaining ₹75,000. Meaning, you secure the opportunity instantly without waiting to arrange for the full amount. However, this margin will differ from stock to stock based on the exchange-defined margins. Your holdings are stored in your demat account, but since part of the purchase is funded by the broker, these shares will automatically be pledged in favor of the broker, and you will pay interest on the funded amount until you repay it. So, with MTF, you can act on time-sensitive opportunities immediately, even when your full investment amount isn't readily available. Advantages of MTF. Immediate access to opportunities. With MTF, don't miss out on any market opportunities again due to shortage of funds. No additional documentation. Unlike traditional loans, MTF requires no separate paperwork or credit approvals. It's integrated directly into your trading account. Risks of MTF. Borrowing cost. If you use MTF to buy stocks and hold them for several weeks, daily interest will add up and reduce your profits. Higher downside risk. Imagine buying stocks worth ₹1 lakh by paying ₹25,000 and borrowing ₹75,000 via MTF. If the stock price falls 10%, your loss affects the entire amount of ₹1 lakh. So picking stocks carefully and keeping the downside risk in mind becomes the key factor. Margin calls. If your stock value drops too much, your broker may ask you to add more funds or even square off your positions. This encourages regular portfolio checks to stay ahead and means having to keep a close eye on your portfolio. The takeaway? Well, clear opportunity. MTF is a smart way to invest when you've done your research and want to make the most of a clear opportunity. So, always weigh the pros, understand the risks before using margin trading facility in your portfolio. Want to learn more? Well, stay tuned for part 2, where we'll dive deeper into how to use MTF effectively.
Investments in securities market are subject to market risks. Read all related documents carefully before investing.